The U.S. financial system is designed one way. Here's how you can beat it. Now I'm going to be talking about our financial system. All right, now I want everybody to understand how our system is set up in the United States. If you look at all the types of investments that you're encouraged to do or that they share with you at your employers or maybe a financial advisor, things that are out there, you know, a lot of it is to generate wealth. By all means, it's to generate wealth. But this tax system that we are all a part of has rules. And those rules a lot of times are set up to where you cannot access those funds until you're 59 and a half. Or if you do access them, they're going to, before 59 and a half, they're going to have penalties associated with that. Or if you want them liquid, or if they're part of the stock market and in their stocks and bonds and things like that, you're going to liquidate them, but they're also going to be tied in with capital gains. So if you think about how our system is set up, tax, 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 delay, delay, delay retirement, pushing you to a later age in life to be able to enjoy your golden years. Okay, so even our Social Security system, you can't touch it till 62, and that's a very small minimum. I believe it's like 60 or 70%. So you don't even get full retirement as far as Social Security till you're at least age 70. Okay, so now you can see how things are set up. So what do you do to combat that? What do you do if you want to retire before 59 and a half? How about if you want to retire at 50? I retired at 50. I was very fortunate. 55. Whatever that magic number is, what options do you have? I'm going to share with you 3 options that you want to consider. One is tied in with what we call is a LIRP. What is a LIRP? An LIRP. It's a life insurance retirement plan. People don't understand it because it's not shared with people. Okay, it's not out for consumers. It's part of a tool that is used in the insurance industry that is designed to accumulate cash. Although you still have a large death benefit. Okay, there's IRS rules that surround those types of products. Now, there's still a death benefit, there's still an insurance product that provide life insurance. However, how do you utilize it to use it for retirement? Well, that's where a LIRP comes in, where you set it up and design it to provide a life insurance retirement plan based on how you design it to accumulate cash that you can have at your disposal tax-free while you're 50, 51, 52, 53, things like that, if you want to retire early. Because the only other option is wait till you're 60. The other option you have is when you're dealing with real estate. We all talk about, how real estate is a great investment, it grows wealth, you build your equity, you buy a bunch of rentals, and then you use the passive income. That's great, but passive income is taxed. So what if you have 5+ rentals, where most of those rentals, if not all the rentals, have more than 50 to 60% equity in them? So they're holding a large portion of value. So now you can borrow off one as long as the mortgage or the rent is paying for that HELOC or that loan. You can borrow off of it and not have to worry about paying it back. And it's tax-free because, again, debt is not taxed. So then you have a second home, a third home, a fourth home, a fifth home. Now you're rotating as you borrow off of each home. That's 5 years. That's borrowing money over a course of 5 years. Well, by the time you get to the 5th year, the first home, that the amount you borrowed should have been paid back through the rent. And then you just repeat the cycle. That's when you hold and you use it as a debt instrument. Again, leveraging your assets, okay? The other option that I'm gonna share with you, it really is a little bit more complex, and you really need to talk to your CPA, your tax advisor. This is called a 72T rule. It's something that's not used a lot, at least for most of the general public. It's probably used more for wealthy clients who have a lot of money and want to access it before 59.5 if it's tied up in qualified accounts, where they can actually set an amount that they can use, really restrictive, you know, that they can use without the penalty of pulling it out before 59.5. It's a little bit more complex than that probably, but I do want you to reach out to your CPA. But those are 3 specific options you have. The other things is if you have other assets, whether even your stocks, say you have, you know, $5 million worth of, you know, stocks in a company, or, you know, things like that, you can borrow against that versus selling the stock, because that leverage the stock growth, because maybe that company is just continuously growing. Instead of selling the stock, borrow against it. So those are things that are options that you may want to consider if you want to retire before 60. But one of the things I truly want you to understand is there are options to retiring at a younger age. Unless you hit the lottery and you make $1 billion, or 500 million, or your inheritance, and you have to work for it, you need to start creating that at a young age. I've said that a million times in other videos. It starts when you are 25, or even before 25. So those are the things I want to leave you with, but these financial options are critical if you want to set yourself up for the future.